Welcome to the second video in relation to time value of money. Our previous video, we looked at the concept of time value of money, where we looked at the perspectives of time value of money, that is the future value and the present value. We looked at the future value of a lump sum amount and the present value of lump sum. We also looked at future value and present value of multiple cash flows. We looked at future value and present value of annuities, and under annuities we looked at both ordinary annuity and annuity due. So in this video we are going to look at level cash flows, but in this case we have perpetuities, and from there we are going to look at application of annuities in investment. So please subscribe to continue watching my videos. So let's look at the level cash flow that are perpetuity. When we say perpetuity, we mean that you expect constant cash flows forever. For example, if you invest in preference shares, if you have a preference share, the irredeemable preference shares, the dividend you are going to get on that preference share is perpetuity, because every year, as long as the company is still in existence, you will be getting that dividend. So when we are determining the present value of cash flow that are perpetuities, we get the constant payment or the constant receipt that we are going to be receiving, then divided by our interest rate R or our discount rate R, and then you can get the present value, which is perpetuity. Remember I said perpetuity is that you expect constant cash flows forever. So that is, you get the constant payment or the constant receipt that we are going to be getting divided by R. So let's look at this example. Find the present value of perpetuity of 500,000, assuming a discount rate of 8%. So please, it's important, our constant is 500 and our interest is 8%. So you can apply our formula, which is constant payment divided by R. Our constant payment is 500 divided by 0.08, and then get our future cash flows. Our present value of perpetuity, which is 6,250,000. So let's look at the application of a sinking fund. So one of the application of annuities. So one of the application of annuity is a sinking fund. And when we say a sinking fund, is that you expect you want a certain amount in the future, a lump sum amount in the future, and you want to invest a constant amount in the different years, such that in period N you can be able to accumulate that constant amount. You can be able to accumulate the future value amount, or the amount that you need to get. So that one we call it a sinking fund. You are making a constant payment in a given fund, and that fund will be giving you an interest rate R, and in the future you need to raise a certain amount. So we call that one a sinking fund. So in a sinking fund, what we want is the constant amount. What constant amount should we be investing in that fund, such that in period N we can raise a given amount? So let's look at this example to be able to understand it fully. Suppose a company wishes to set aside an equal annual end of year amount in a sinking fund account earning 10%. So this is our interest rate per annum over next 5 years. So this is our period N. The firm wants to have 5 million. So this is the future value we want to raise, 5 million. in an account at the end of year 5. So this is still our N. So this is our future value in our outstanding bond. How much must be deposited in account at the end of each year? So we are making at the end of each year. This is also an important, this one, end of each year, meaning you are looking for ordinary annuity. So which formula are we using? This is automatically a future value annuity because you are going to be investing in a given fund, and we have the future value we want, which is 5 million, and we have the 10% interest rate, and we have N. So what do we need is the constant amount PMT. So let's look at the solution. So another application is what we call a deferred annuity. A deferred annuity wants to be similar to a sinking fund. But the difference is that in a deferred annuity, you want to invest a lump sum amount today, and this lump sum amount today will help you to pay a constant amount in the future. So that one is the deferred annuity. Whereas a sinking fund, you are investing a constant payment, a constant amount, and this constant amount you are investing will help you to pay a lump sum amount in the future. So that one is a sinking fund. So you should separate a sinking fund and a deferred annuity. So still, in a deferred annuity, it means you want to pay constant. For example, you want to study your masters, or you want to do a certain course in the future, and you are going to be paying a certain constant amount in the future. So how much are you going to, should you invest today, which will enable you to pay that constant amount in the future? So that one is a deferred annuity. So look at this example. Suppose you wish to provide for college education for your daughter. She will begin college 5 years. So this is our end from now. And you wish, this is where it's going to begin. It's not the end. And you wish to have 1.5 million. So this is the constant you are going to be paying in the future, available for her at the beginning of each year. How much must you invest today? So we are looking for the lump sum amount to invest today at 12%. This is our interest rate, annual rate, in order to provide. So this 1.5, you are going to pay it for a period of 4 years. So as you have said, automatically you are looking for amount to invest today that is going to help you to pay a constant amount in the future. Automatically, this is a deferred annuity. So let's look at the first the solution. We have got many 3 options that we can use to solve this question. So the first option that we can use is to get these cash flows, because we are starting to pay from year 5. So we are going to pay year 5, year 6, year 7, year 8, because we are going to pay for 4 years. And every year we are going to be paying a 1.5. So we can get the present value of these cash flows from year 5, year 6, year 7. So we are using the present value interest factor of 12%. So you read this one in your financial table, read this one in the financial table in year 6, read this one in your financial table in year 7, read this one in your financial table in year 8. So you get you multiply, you get the total present value of these cash flows. So it means you need to invest this amount at the end, at the beginning, to be able to pay these annuities. So that is option 1. Option 2 is to get annuities for 4 years. Then after getting the annuity for 4 years, you discount it backward for 4 years. So then you can also, you need to discount this figure. So I did not do it, but you can get the. So as I said, you have got the annuity for period for 4 years. Then after getting the annuity for 4, this becomes now your future value. So once you get this future value, you discount it backward for 4 years. So you can use this formula to calculate it, or you can use this where you are going to read this one in your financial tables, and then you get your present value or lump sum that you need. Another option that we are not written, but you can look at it, is that you may consider that these cash flows occurred for a period of 8 years. So you get the present value annuity for 8 years, then minus, because we only paid the annuity for 4 years.